how to do financial projections for your new business. Today is the fourth and last episode of how to write a good business plan. Financial analysis is one of the key areas investors will read once they have received your business plan. It also gives you a chance to assess your new business, whether it will be profitable and when will it be profitable. My previous job as an equity analyst at investment bank has prepared me to be an expert in doing financial analysis and projections. Now I'm going to share with you all my tips how to do these financial projections. Watch till the end because I'm going to show you step by step how to build financial models so you can do your projections for your new business. Hi my friends, this is Vivian from YIPPEE. I've been an entrepreneur for more than 12 years and I'm also a business consultant helping people build happy, successful business. In this channel, I'm going to share with you all my practical tips that I have learned from my own entrepreneurial journey. My mission is to help you become a successful entrepreneur. If you want to be successful, please subscribe to follow. Unless you have experience in the financial field, most new entrepreneurs do not know how to do a financial projection. No matter you need to write a business plan or not, I highly encourage you to do financial projections because it will help you to understand whether your new business is a good investment, how long it will start becoming profitable, and how profitable it will be. So now just let me tell you how you can do it step by step. Number 1, calculate your startup cost. This one is quite straightforward. All you need to do is to list out how much you're going to spend for each item to get your new business started. Here's the list of some setup costs you can reference. Registration and license cost, rental and utility deposits, property agent commission, equipment and fit-out costs, marketing costs such as brand design, advertisement, and startup working capital. I suggest you to set aside at least 3 to 6 months working capital, which means you will have enough money to get you started in the first 3 to 6 months in case you're not making any profit yet. But the exact amount really depends what business are you in. If you run a business like restaurants, retail business that you will get customers paid you rather quickly, almost immediately, then a shorter period of working capital will be totally fine. If your business will need longer time before you can receive money from your customers, for example, tech startup, you might already foresee that you're not going to generate any profit in the first 2 years. Then you will need to save up a lot more money for working capital. So just sum up all the items and the total is your startup cost. Let's look at how to do financial projections now. Step number 2 is you need to figure out all the financial assumptions for your new business. Do research because the closer it is to reality, the more accurate your financial projections will be. You need to know exactly how much you need to pay on items such as rent, staff costs, admin and accounting costs, utility costs, marketing costs, registration and licensing costs, insurance costs, and profit tax rate. Step 3. Work out what drives the growth of your business so you can calculate the projected sales. Sales equal to price times volume. So for the price, you need to know how much does each customer will pay you on average per month. Whereas volume, you need to figure out how many customers do you expect per month. Now let me show you how to put all these into a model and work out your financial projections. I will use a restaurant business as an example. And this new restaurant business will locate in Hong Kong, and I will use US dollars in my financial forecast for your easy reference. This is a table of all the costs you will require to fill in the financial models. And all these costs you have to investigate as close as reality, else your modeling will not be correct. And for a restaurant, In Hong Kong, I have investigated I will need to pay a rental cost for 16,000 per month. So the annual cost just times 12. Staff cost, I'm going to pay 18,000 per month. This is the staff cost I will need for the whole year, and I estimate it will be 10% annual increase for the next 5 years. Admin and accounting costs, I estimate it's going to be $6,000 for a year. Utilities, $7,000. Marketing costs, I'm going to spend $100,000 as startup, and the annual licensing cost will be $650. Insurance cost is $2,000. Insurance in Hong Kong is not too expensive, so you have to check your country and reflect the real reality. The profit tax rate in Hong Kong is 16%, and cost of goods sold, here I assume 30% of sales. For the items I've listed out earlier to calculate my startup cost, it's going to cost me $640,000 as startup, and I'm going to depreciate it in 10 years. Next, we're going to do the sales forecast. For a restaurant, I need to know how much each customer is spending on average and how many number of guests I will have every day. Then I will get my sales. So here I assume my lunch set is about $12 per person. So this is gonna be the average per head spending for lunch. And I estimate I will have 60 number of guests during the lunch time, and the sales is just 60 times 12, gonna be 720. Dinner, I got a dinner set for $30 per head, and I estimate I'm going to have on average 80 number of guests per day during the dinner time, and this is the daily sales I would get for the dinner. Sum up the total is going to be 3,120, and I just link this sales to this table. Daily sales is 320. Then I'm going to estimate how this sales will grow in the next 5 years. One key factor that's going to affect your daily sales is the amount of marketing budget you're going to spend. Normally, the first 2 years we will spend more to boost the sales, also for people to know about your business. So I estimate, because of the increase of my marketing dollar, and I'm going to get 20% increase in my sales, daily sales in the second year. Third year, I assume my sales increase will be 15%, and that will result in 15% increase of sales compared to the second year. The fourth year, I assume, will be 10% increase, and the last year as well at 10% increase. So how are you going to get this number? As I just mentioned, this has a lot of relation with the marketing budget that you spend. So pay attention how much you're going to spend each year. If you spend more, then go ahead. You can estimate you're going to increase the daily sales more in the next year. So number of operating years, I assume we're going to operate 310 days during the year. So we're going to put the sales times operational days per year, and that will be your annual sales. So now we have the annual sales projected already here. Then we can go ahead to start our income statement forecast. So you can see I just linked these two cells together, and I got the restaurant sales. I did some assumptions in my cost table here. So you can see my cost of goods sold is 30% of sales. So here you can see this is 30% of the sales, and I get the cost of goods sold for the 5 years. Gross profit is just sales minus cost of goods sold. Okay, and then we got the rent earlier assumption with this number, going to be the same for 5 years. Staff cost, again, this is the 260 we get here, and I assume 10% annual increase for the next 5 years. So you can see I just do this 10% increase every year for the next 5 years. Then just plug in the admin, accounting cost, utilities cost. My first year marketing cost here, I assume 100,000, right? So here's 100,000. And then I mentioned before how to calculate the marketing budget. I think it was in my last video, I shared with you guys how to set the marketing budget for the next year, which I use the X% of previous year's sales. So here I'm going to estimate, I'm going to use 10% of previous year's sales as my marketing dollar. And the next year I'm going to spend 8%, and the last 2 years I'm going to spend 7%. So I got my marketing cost like this. Licensing cost, insurance cost, straightforward, is basically the same. EBITDA is earning before interest, tax, depreciation, and amortization. So this is the Chinese translation. And basically just gross profit minus all the costs you just list out, and you got the EBITDA. Depreciation, how I get this depreciation is from here. I'm going to spend 640,000 as my startup cost. Depreciation I put in 10 years, so basically each year I'm going to depreciate $64,000. EBITDA minus depreciation is going to be this number. Interest expense, I'm not planning to take on any loan from the bank, so I don't have any interest expense. So EBT, which is earning before tax, would be the same as earning before interest and tax. Taxation, I got the tax rate in Hong Kong is 60% here. So this is just 60% of EBT. And I got the net income. That's how I do the income statement forecast. It's actually quite straightforward and not that difficult as you think. And you can also play around to check how does your assumption will change, which will gonna affect your models. For example, what if I cannot do 60 number of guests during the lunchtime? I only do 30. And I only do, say, 50 for my dinner. And I go down and see my net income is totally changed already. You can tell I'm not making much money at all. If I don't do 50, I manage to do 60, what's going to happen? Then I can see, oh, from the third year I start to generate profit, right? So this is how you can play around what you can do with your modeling and see when is your break-even point. And this is your income statement forecast. Next, move on to cash flow forecast. Cash flow forecast is important because you need to know how much money you actually got on hand. And this is going to affect your expansion plan as well. If you got more cash flow, then you can start planning your expansion earlier. Cash flow forecast is really easy. Just do EBITDA, EBITDA actually, EBITDA here, right? Just this number minus taxation. Bear in mind that tax actually delay 1 year. You pay tax 1 year later. So your second year is going to be paying the first year tax. So you can see how I link the cell together. And just EBITDA minus taxation, and that's your net cash flow. Because I'm making a profit and I have positive cash flow. You also be careful to revise your cost table if any situation change. For example, you don't get this spot in fact you are spending slightly more, you're spending 19,000 per month, and that's how it's going to affect you at the bottom line. I'm still making some money even with the rent increase, so you can also see how much you can afford in the rental cost. Got it? So now you can see this business is a good investment that you can go ahead. Doing a financial analysis and a projection like this will help you understand how fast will you start making profit, how much profit will you make every year, because that's going to affect the cash flow you generate every year, and it helps you to plan for the expansion. The last item you need to write for your business plan is the team. This one is really straightforward. You just need to write the bio of everyone on the management team. Remember to emphasize how the experience of the management team will contribute to the success of this new business. That's all for today. I think by now you have a good understanding already how to write a good business plan and how to do your financial projections. If you haven't watched the other 3 episodes, check out the link below at the description box. If you have any questions about entrepreneurship, please subscribe to my channel and leave me a comment below. If you like what I do, please click like to my videos, and I'm going to see you all in my next video. Have a good day. Bye!